Hello everyone, hope you're all doing well. As you already know, earning season is already underway, and for the most part, banks have reported relatively pretty okay earnings, such as earnings coming from Goldman Sachs or Citigroup. Morgan Stanley, on the other hand, did not report really great earnings. Pretty much today's video is not to be talking to you about earnings, but to really focus your attention on the global economic slowdown that we have. As you can see in this table here, recently the IMF, the International Monetary Fund, came out with this data over this past 3-day holiday weekend. The IMF, you should know, is that they are an international organization. They're located in Washington, D.C., and there's almost 190 countries that work together, and they work on essentially making sure that there is high employment, sustainable economic growth, and to really reduce poverty around the world. In this table, I really want to highlight to you the US and also China. As you can see, in 2019 and 2020, projections are relatively much lower than we currently are in 2018. And what you're going to be seeing this upcoming week, and we're already seeing in the US futures, is that the stock market is down based on the report from the IMF saying how really after 2018, the global growth will be slowing down from 3.7 to 3.5%, as you can see here. Not a large drop, but definitely something to really keep in mind. On this next bar graph here, I'm really showing you just how, again, the IMF, they're really emphasizing how moving forward for the next 2 years, global growth projection is going to drop. And the reason why this is very important is because the IMF, they did mention how they still believe that there is risk to more significant downward corrections in the future. And they actually mentioned how, even though the financial markets in advanced economies such as the US and in Europe have, for the most part, been holding up relatively okay with the trade tension, they do believe that there's much more financial tightening that is going to be happening in the future. For example, in the US, as you can see here, again, dropping to below 2% GDP in 2020. The reason for the US is mainly because of really two things, right? Higher interest rates from the Federal Reserve, and also from the unwinding of fiscal stimulus that we will no longer have in 2019 and 2020. Trump's tax plan cut, where companies brought cash back from overseas and were taxed a much lower tax rate, that is now fading away as all the cash has, for the most part, been brought back. And this is actually concerning the US market. As far as China go, I think it's really important to note that China, they themselves, they are fearing a slowdown as well, and I'll talk about that a little bit more later. In this table here, what I want to show you is that the world economy, really in one chart. This is a really great table here that shows you all of the data, obviously with US as number one in terms of the global GDP as at almost a quarter, 25%. China's right behind at second place with 15% of the global GDP, and Japan is very important, is at about 6% of the global GDP, and this table here is as of 2017. So when the IMF, when they're coming out with the table and they're saying how their projection for Japan is essentially how they're not growing at all in 2020, at essentially 0.5% growth, that is alarming. It is alarming that your top three countries, US, Japan, and China, are all slowing. This is not a good sign for the global economy. And, now I'll be talking about more specifically about China economic slowdown. Donald Trump knows very well. He's saying how China needs to do a real trade deal with the US and quit playing around because they're slowing down. And very recently, China's GDP for the fourth quarter of 2018 came in at 6.4%. And although this sounds a very high number compared to the US, right? Please keep in mind, China is still an emerging economy, whereas US is an already developed country here. And the reason why the China slowdown is actually happening quicker than a lot of people expect is mainly because of the trade tension that's continuing to linger on, and it's not fading away. And one important thing is, why do we focus on China so much? Like, why do I focus on China so much? It's really because in the whole 2018, China's growth rate is 6.6% for the whole 2018. This is the lowest level since 2009. And one thing you should know is that China accounted for more than really a third of the global GDP growth in 2016. That's pretty significant here. And the way that the Chinese market is reacting right now, the Chinese market is open. They're down. So what I'm showing you here is a Shanghai Composite Index. This is for China's stock market. They're down about negative 0.7% based on the global slowdown news. In terms of like the US futures market, they're down almost negative 0.7% as well. So a lot of great things to keep your eyes on. The global growth economy is slowing down. That narrative has not changed. So please keep this on your radar. So everyone, thank you again for watching this video. I really hope that this video gave you a little bit more insight on how the International Monetary Fund is thinking, how there's revisions coming down for the US, Japan, and China, as well as the global economy. So please keep all this in mind as we do continue on throughout the earnings season, and that the US stock market, it is affected by how other large countries are doing, such as China, Japan, and Germany. So thank you all again for watching. If you thought the video was helpful, please drop a like. Feel free to put a comment below. I promise you I will respond back. Thank you all for watching again, and until next time, see you guys.